Hello, everybody. So I just wanted to go over briefly how I was able to profit from the market crash in the beginning of this year. As you recall, we talked last time about inflation, the CPI and the PPI, and I've been following those every month because, as you know, a big chunk of the market returns the past year have been due to the influx of money from the Fed and the fact that we're in a low interest rate environment. And I was waiting for interest rates to go up so that I could profit from the crash. Now, if you look at the SPY, what we've had is we didn't experience a market crash until, well, the beginning of the year, January. I think markets were open on January the 3rd, which was when I started shorting the market. A lot of you will say, how did you know that was the top? Like, how could you time the top? How did you know it was going to crash? Nobody knows when the stock market is going to crash. Nobody knows how to time the top. I mean, nobody has a crystal ball to look into the future. What I've done, my thesis was looking at the data. If you go back, how the SPY evolved the past year, you can see that from the bottom of the post-COVID crash, we've almost doubled the total value of the S&P 500. Not only recouped all that we had lost, but we even added 30% more value to the total S&P 500 market cap right before the crash. Now, how can that be? A big chunk of this bull run was due to the Fed's money printing. If we look at the historical P/E ratio of the S&P 500, for the past century, we were usually between 10 and 20. Now, 15 is what we call the fair price for a stalwart company, what Peter Lynch defines as a company, as a cash cow business, a company that makes substantial amounts of cash flow without necessarily growing its earnings. Why 15? Obviously, this can change a lot depending on the growth rate of earnings, but for a mature company that isn't able to grow its earnings substantially, you should be willing to pay roughly 15 times its earnings or cash flow. Any investment, not only stocks, equities, but also real estate. If you can rent out a house for $10,000 a year, you should roughly be willing to pay $150,000 for that house, give or take, because we usually compare that return, that earnings yield of 1/15, so 6 to 7%. We compare that 6 to 7% yearly return to other risk-free rate returns. We often use the US long-term treasury bond for that. But a 6 to 7% yearly return, that's a healthy return for any average investment. Obviously, the higher the PE goes, the lower your subsequent returns. If you're paying triple, 3 times as much for the same earnings, so let's say you're paying a price to earnings of 30 for any investment instead of a price to earnings of 10, you're paying 30 times as much for the same earnings. That company better grow its earnings to compensate for the higher valuation multiple that it has. When we go over the total market cap value of the US stock market, so this is the Buffett indicator. It's named as such because Warren Buffett has often mentioned it as one of the most useful metrics to determine where valuations stand at any given time. This is the annualized GDP of the US, $24 trillion. That's the total amount of wealth that the US produces in a year or last year. This figure tends to grow roughly at 2-3% per year, slightly lower going forwards. In a healthy economy, you would expect that the total market cap value of the US stock market should be equal to the yearly GDP. Now we're quite substantially above that. So that's why we say that the market is overvalued, because currently the S&P 500 and the Russell 2000 and the Nasdaq, so the total US stock market cap, is way above the annualized GDP of the US. You can check it out on currentmarketvaluation.com. I think they also have one on gurufocus.com. Where are we with market valuations? So the same conclusion. Stock market significantly overvalued, and it's likely to return negative. You're likely to get negative returns from now on going forward because of this that we talked about. So in the dot-com bubble, obviously price to earnings shoot up higher, then crashed and burned. The same in 2008, and now the same for the past 2 years. So knowing that we're in a bubble, and knowing that the stock market was due for a correction, for a crash, since inflation was ramping up higher and the Fed said that they were going to raise interest rates, or they were going to be forced to raise interest rate anyways. So I didn't care if they didn't want to raise it back in November or December meetings, because I knew it was going to happen anyways, or at least that was my investment or trading thesis. I looked at the month of December and we were still quite up. And so I thought, okay, well, the reason it's still up, it hasn't crashed yet, is because there's an incentive by all the market participants, large institutional firms, hedge funds, banks, everybody involved in the stock market had a vested interest in keeping it high until the end of the year. Why? Because when annual performance reviews happen, bonuses will obviously be higher if everybody shows a good performance for that year. So I thought, okay, well, the market was already supposed to crack around December or November. I was still hoping that it would crash back in September, October, November. I was waiting for it for several months. And I said, okay, maybe they're trying to keep it up until December 31st for not only taxation issues, because they want to sell their holdings after holding them for 1 year to pay lower taxes on their realized profits. And obviously, they also want to make sure that all their bonuses in Wall Street and so on will be substantial. So I thought, okay, maybe from January the 1st, or January the 3rd, when the markets were open, forward, we'll finally have some kind of correction. That was what I hoped. And so I took a short position in SPY puts on January the 3rd. When it happened? It just happened that it was almost the exact top. So, the harder you work, the luckier you get, as they say. I didn't get the whole crack. And this is the Nasdaq, by the way, QQQ. But it's the same so this one was roughly minus 20% from top to bottom up until today. The SPY, so everything coincided. It was, I was dumbfounded. Like, I didn't know it was going to work that well. So I got just like a small portion of the move. I covered some here when it cracked like minus 7 or 8%. I didn't know it was gonna fall more. But yes, I just want to highlight to you that when you're able to really understand things at a deeper level, when you understand all the intricacies that go into the stock market, how inflation affects it, how interest rates affect it, how people's expectations affect it, how taxation issues, yearly performance reviews, how money flows from one sector to the other. When you're able to bunch a lot of pieces together, you'll be able to make better informed decisions. It doesn't mean you will be right. It doesn't mean you will make money. Nobody knows what's going to happen tomorrow. by definition. What we do in order to make money is to take educated guesses and then construct our trades or investments in such a way that we get a larger upside than a downside. If I had been wrong, I would have cut it after losing 1 or 2%. As I was right, I just let it continue to unfold, to maximize my profits. I will make a separate video on that, about why forecasters never make any money and why some traders with a 40% win rate, so even worse than a coin toss, are millionaires. It's all on the payoff function. So being right in the stock market won't make you money. You could actually be wrong and still make money. I think you'll love that video because it will open up your mind to ideas that you haven't thought about before. So thank you for listening in, and see you next time.